The laws for income taxes generally require that 401k plan distributions be reported as income and be subject to taxes. We typically see this with distributions from individual retirement accounts, IRAs, which are reported on line 4A and 4B of Form 1040, the individual income tax return form. The 4A box is for the full distribution amount and the 4B box is for the taxable portion of the distribution. It is common for taxpayers to fill in the 4A box and omit the information in 4B. However, for most taxpayers, the correct way to report the distributions on the income tax returns is to have the taxable amount in box 4B and leave box 4A blank. This often leads to an understated tax that is caught by the IRS's computer systems. Commonly known as the early distribution penalty tax, is an additional tax imposed on distributions that are received before the individual reaches the age of 59.5. The purpose of this tax is to discourage individuals from accessing their retirement savings before retirement age. This tax reported to the IRS on Form 5329, the additional taxes on qualified plans, including IRAs, and other tax-favored accounts. This form used to report additional taxes imposed on early distributions from qualified plans. Taxpayers must report the early distribution penalty tax on Form 5329, and then add amount of penalty tax to taxes owed on Form 1040. There are several exceptions to the additional tax of 10% imposed by Section 72. Most common exceptions are: the distribution is made to a beneficiary after the employee's death. The distribution is made because the employee is disabled. The distribution is made as part of a series of substantially equal periodic payments over the life expectancy of the employee. The distribution is made to an alternate payee under a qualified domestic relations order. The distribution is used to pay certain qualified higher education expenses. The distribution is used to pay certain qualified first-time homebuyer expenses. The distribution is made to a reservist called to active duty after September 11, 2001. The distribution is made to a taxpayer who is unemployed and uses the distribution to pay for health insurance. The distribution is made to a taxpayer who is experiencing financial hardship. There are regulations and numerous court cases that help clarify these exceptions.